Right, good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays again. And thank you all for joining us this morning. Sadly, this will be our last session for 2024, but right at the end, I'll tell you what's coming in 2025. We've got a really good lineup for you. China has been a much debated topic for the past 2 years since they reopened the economy. There's been issues in the property market and a bit of sluggishness with the economic recovery. A lot of stimulus packages that we've seen coming through the past year, especially the past 2 months. Sharp bounce back in the share prices of the stock markets during October. A lot of clients are asking, should we revisit our exposure to China? Whether it's direct exposure in China, A or H shares, or even what is the impact of China on the rest of the world with all these stimulus packages, and what could one expect? And this will be our focus for the session today. And joining me this morning to moderate the session, none other than Tuvonga Chivize, the Chief Investment Officer at Apex Investment Consulting, South Africa. Good morning, Tuvonga. How are you?
Good morning, Eugene. How are you doing?
Very well, thank you. Tuvonga, I'm really glad you're actually joining our session. To moderate the session, because I know you and your team has been watching China very, very closely. I know from a portfolio construction point of view, you're also including China in some of the portfolios. Lots of questions from clients on China. We've seen commentary from some other managers and a lot of debate on maybe not China. Some are very pro-China. So really looking forward to the session this morning to unpack it a bit more. And I will hand over to you to introduce your guests as well. Thanks, Dave.
Thank you, Eugene. Good morning, Faisal, and good morning to all of our audiences. Faisal, I think on one hand, you and I are probably singing from the same hymn, sense that we saw understand the opportunity set and approach China. Concerning to me when I look at the amount of allocations to emerging markets across our portfolios now at a historical low. And as the interest in emerging markets has dissipated, the rise of risky emerging markets, excluding China, appears to be rising. So from a global perspective, we're definitely in the minority. I guess that's one thing to sort of that concerns me before we start this conversation. And excluding USA, the biggest allocation in that is now Taiwan, over 26%, and the stock that's dominating that is Taiwan Semiconductors. And when I look at the Magnificent Seven in the US, apparently 90% of their supply chains are embedded in that stock. So we've got this thing that is intertwined, whether you look at MSCI EM or MSCI DM, there's a big part of China in there, whether you like it or not. And then finally, just thinking to maybe for the sake of the audience, is that we've got an allocation to developed markets, we've got an allocation to South Africa, maybe emerging markets excluding China. In the context of that, why China? I guess that's probably like a good way. So I mean, just maybe those are the key burning issues from my side as we get into your presentation. Do you have any comments around that as you get into your story?
Thanks, Tuvonga. In a second, I'll share some slides, but just a larger picture of the longer term perspective on why there's a role for China in our portfolio. You're talking about the second largest economy in the world, which is significantly underrepresented in the indices that a lot of us invest in for kind of like technical reasons. And so, and you have a lot of growth drivers in China that you don't get in the US and other markets. So the allocation to China is absolutely justified. Some of the largest companies in China and the world are actually in China. Then on the other perspective, there is the aspect of diversification. So if you saw in markets, we know about the US equity markets being, you mentioned Magnificent Seven. The indices over there are very much driven by some very large companies that are very expensive, no doubt great companies, very expensive, And should there be a slowdown in the US economy, then really those stocks could reprice quite significantly. On the flip side, what you have is the Chinese opportunity set is very different. It's valued very differently. It is now coming from a economic downturn to recovery as opposed to the US and the other side. And what you've seen this year, for example, is when the US market has crashed, during those weeks, you have seen the Chinese market actually go up a lot. And China has outperformed the US markets significantly in those times. So right now, very particularly right now, China offers this incredible diversification benefit from the rest of the world, which is dominated by US, which in itself is dominated by a few other companies. But why China now? And to talk a little bit about exactly what's going on in China right now, I've got a few slides that I'm going to share now. Let me do that now.
Faisal, as you sort of get into your slide, like I've got maybe one question too, we can just maybe get out of the way. Maybe I'll start by sharing from our side. From our side, our global equity benchmark is an 85-15, so 85 DM and then 15% emerging markets, and we interchange that 15% with China. So, and when we are most aggressive, that can go up to 30, so it becomes a 30% EM, 70 DM. From your side, what do you think is an ideal and neutral starting point for China or for emerging markets? And given the numbers that I've sort of talked about and what you've said, isn't that underweight still? Or yeah, what are your thoughts?
Well, I think on specifically that front, let me just so that this loads up at the same time.
Okay.
Great. So yeah, just to answer that question directly, I think that's about the right magnitude, which, as you said, rightly is more than a lot of other asset allocators. Now, remember, with the size of the Chinese economy and the stock market, were there no risks at all, whether if there were no risk premium required, we would probably have the largest allocation to China after the USA, just given its size. However, there are some risks involved, which we can touch on. And China is ultimately an emerging market. So one has to have a smaller allocation to China than it should it should be allocated had there not been the risk given its size. So I'd kind of agree with you, and that would be an overweight position relative to a lot of allocators right now. Did I answer your question?
It does, and we'll continue to unpack it as we go through our session. So yeah, I'm curious to see what else you have to share.
Great, awesome. So I'm just gonna go through a few slides. In the interest of time, I'm just gonna skip on the slide. I mean, look, we're a dominant player in China. It's a deep vertical that we concentrate on, and we've been doing that for quite a while. But let's perhaps start with this. This is what everybody would be familiar with. You know, China is an economist state. It's had significant geopolitics with the U.S. House prices down a lot. All true. Population growth has been stagnant. Labor costs have been increasing. Workforce is actually falling. Consumer in China has been stretched. These are all facts in the last few years, and we need to respect that. But on the flip side, we must never forget the long story, which is it is still the world's largest kind of urban consumer in the world with a lot of savings. And what has happened in these last few years since the COVID lockdowns we read about in 2022 is the consumers have been saving even more. This is the Chinese saving rates, and you can see how it's been kind of been increasing. And as a result, there's a lot of dry powder for the consumers to actually go out and deploy should their confidence increase. It's also a very tech-savvy population, and as a result, no surprise that some of the largest tech companies, some of the largest internet companies come from China. Being such a large country also comes with a lot of skilled entrepreneurs. It turns out there are 240 million graduates. It turns out 10 million new graduates every year. A lot of those people come in from science, and as a result, they go out, establish startups, and as a result, unicorns, meaning high-profile companies that are growing significantly from nothing, you only find them really in two countries, USA and China. So in an incredible, hungry population, people ready to go out there and start businesses. And so again, no surprise that China in these last few years has started to lead in some of these local these new economy sectors, whether solar panels, drones, mobiles, high-speed railways, lithium batteries, industrial robots. Half of the world's industrial robots are actually now made in China, and it's come from nowhere. I mean, China was unpresent in all of these markets in 2005, and you can see how they have dominated in these sectors over the last few years. Even these entrepreneurs going global. These are apps that are used in the USA, and 4 of the top 5 apps in the USA are actually Chinese companies. Number 2, 5, and 8 most downloaded apps in 2023 were Chinese. Half of shopping apps downloaded in USA are Chinese companies. So when these battle-hardened Chinese entrepreneurs go global, they also tend to lead the world. China also leads in infrastructure. The physical infrastructure is so important. The other day, it was like we were traveling from Beijing to Shanghai, and throughout the journey, when the trains are going at 350 kilometers an hour, uninterrupted, pretty much uninterrupted 5G connection. I barely get any internet connection if I'm in a suburb of London on the train. And what's happened over the last few years is the Chinese corporates have become a lot more productive. This is to take account of the fact that the Chinese population is aging, workforce is reducing, and as a result, what you've also got is companies moving from labor-intensive to robotics, and really taking the lead in manufacturing, making sure that they are the cheapest and most efficient and large-scale manufacturing, which no country can match. And today it's not because of cheap labor. And this chart can just give you quick examples of how China has led into manufacturing. So CATL is the world's largest manufacturer of batteries. It's come from nowhere. 2016 used to be Panasonic and CATL. Today, by far, CATL is the world's largest lithium manufacturer. It took just 7 years. Another interesting fact: Tesla's Shanghai factory. The Chinese are so efficient at manufacturing that the gross margin of cars coming out of Tesla factory is 50%. When Tesla manufacturing its cars in anywhere else in the world, it takes its margin from those cars is only 18%. Significant difference. Let's talk a little bit about this tech wars. So Huawei, as many of the viewers would know, is one of the most sanctioned stocks in the world. Huawei can't buy any tech from international world, so it can't have Android in its phones. It can't have any chips. What they've done in these periods when they've been sanctioned and isolated by the world, it's continued to lead with incredible products. I mean, if you go to a store in any city in China, it'll be packed. It has phones that are competing, where its operating system is their own, their chips are their own, and their performance is just as good as some of the best Android phones that you can get. Not only that, in this period of being sanctioned, they've come up with a fleet of incredibly beautiful cars that are selling very quickly in China, and from nowhere, only launched in the last few years. Talking about the economy, one thing to really note is the Chinese economy actually has been brought down by this real estate sector. Other parts of the economy, retail, sales, manufacturing, exports, have actually held up quite well. It's really the property sector that's hurt. But on the flip side, during the same period, in another example, is China has become the world's largest manufacturer, exporter of vehicles in the world in the same time. And that's because of this advantage of integrated supply chains that it benefits from. And perhaps the last part of what's happening in the economy right now, a massive stimulus package has come up. I don't have time to go through the details, and more stimuluses continue to come through. That's why we saw in 1 month, a few months ago, the market went up by 20%. You just have a look at the chart on the right of how these are the kind of the daily movements in September of the local Chinese stock market, and you can see how when the news came out, basically the president Xi came out and basically said that we recognize that we will do whatever it takes to build out the Chinese economy. And as a result, what you have seen is the Chinese economy recovering from a very, very low base. Chart on the left shows you the performance, the orange of Chinese stocks relative to US stocks. And you can see over these last few years how their share prices have come down. And this recent recovery is a blip in terms of the greater scheme of things. And the chart on the right shows that the Chinese markets are trading at significant discounts relative to the US market, and also emerging markets have also suffered during this period, but China has so valuations are also very attractive, as I said. And the last few charts. And on the flip side, while the Chinese valuations are very low, their expected growth, this chart on the left shows the expected annual earnings growth estimates for a number of markets. And what you can see is expected growth actually across the emerging markets, including China, is significantly higher than developed markets, which are valued a lot more. And the Chinese have actually been buying back the stocks, doing very shareholder-friendly activities that also should benefit stocks. I guess predominantly this has also led to a recovery in the property market. This left chart, what it shows is kind of since the stimulus has been, or kind of that President Xi saying we will do whatever it takes moment. What you've seen is short-term sales across Chinese cities from this compared to the same time last year have gone up significantly. 200% increase in new home sales in Beijing, for example, and 150% increase in secondary homes. So as the consumer confidence increases, we should expect those consumers to come out, buy more TVs and fridges, which is beginning to happen, and that should lead to a recovery of the Chinese market. I think I'm gonna finish with this last slide to say what has happened, and this is now talking about why I have a dedicated exposure to China, is a lot of investors, global investors in the US, during these hard times, have actually fallen behind in their coverage of Chinese stocks. There's a recent article in Bloomberg which basically says CIOs in the West have actually fallen behind in how China has evolved in these last few years. China today, it's a very different country, and the investment opportunity set in China today is very, very different compared to some years back. And had you not been staying in touch with that over those last few years, you got a significant amount of catching up to do. So these are a few slides that I wanted to just share to start a discussion, Tivanga, and happy to take any questions in the remaining time.
Thank you so much. So I'm going to also be checking for questions from the audience here. So please do send us your questions. I have one from the audience. So thanks to Sean who has sent this. So I'll read the question out to you, Fazal. It says China is SA's largest trading partner. More exposure to China markets deemed EM would in effect be doubling down on China as future prospects. Your views, please. So I think it's that whole distinction or separation between SA and China, but I guess you can also interpret it in your own way. So that's the first question we have. Thanks, Jishan, for this question. Please keep the questions coming in. Appreciate it.
Yes, that's a good point. In periphery, one might think that. I think whilst that argument makes some sense, South African stock market is a high beta market, and really historically, where developed markets have suffered, the South African market and the currency have tended to suffer more. And as I've kind of said, right now as we stand, China has some unique issues, very unique to itself and very different to, say, developed markets and South Africa. We're investing in Chinese stocks, especially relative to USA, gives significant diversification benefits. And given I showed you charts about the valuation of stocks. even though the growth expectations are higher. So they are priced more effectively, and China's coming out of this downturn going in, whereas potentially at some point the Western world has to dip down, or the US at least has to at some point. At that point, that Chinese stock market. And I think whilst the question was very much South Africa versus China, here what we're really talking about for South Africans, the international exposure that they have, and how much do they have to say US and developed markets versus a China per se. And I think it's much more about China versus rest of the world bloc as part of our international exposure as South African investors, as opposed to comparing South Africa to China directly.
Yeah, I'll maybe add on to that, Faisal, and you can also give me a sense of I think what you think to the response over and above what you've said. So if you look at South Africa versus China, the idea that they are similar, there is also ways you can bring that into portfolio construction. If they are similar and they are both attractively valued, and let's say your neutral allocation to South African equities is say 45%, as you would have in a South Africa multi-asset high equity fund, if those things are equal easily, you could have 10% of that risk allocation coming out of South Africa allocated to China. And I think you would still have a strong case for China. And let's look at a scenario where you are as aggressive as saying half of my South Africa, let's say 1/3 rather of my South Africa risk budget, I'll use China. So that means instead of having 45% SA high equities, you have 30% SA high equity and 15% China. Now let's tackle what's wrong with that. Every one of the structural problems that South Africa is struggling with, be it education, be it infrastructure, be it savings, China has done significantly better, has resolved them into global leader status. South Africa's population maybe is 50 million. Let's just say 40 million of those are middle income citizens. In China, that number is 400 million. So, and then, so on whatever metric you talk about, South Africa is beaten. If you look at something like the two-pot system, I don't know what the numbers are. Let's say we're going to get 100 billion out of the two-pot system. 100 billion divided by 20, if you use the USD exchange rate, that's about what, 5 billion worth of stimulus from that. Whereas currently Chinese citizens, who are, by the way, 10 times larger, if you just look at the middle income, are sitting on about 7 trillion US dollars. If you look at the number of graduates, 10 million coming out every single year, that's a big part of South Africa's population. So in the context of us using South Africa as and China is the same, I think then you can allocate part of South Africa's risk budget to China, and you still wouldn't have an uncomfortable portfolio. But then again, coming back to Faisal's question, it's still also distinctly different from US. So you could still have a very strong case of reducing the risk budget to DM equity. So I guess in the sense of doubling up, there are ways in which you can diversify the South African risk budget for something that is similar, but with much stronger fundamentals and much stronger policy behind it. So maybe that's one way of sort of adding to what you've said. I have another question for you, Faisal, from the audience, and it's anonymous. I would really don't know their name. So they say, what access is preferred, mainland China market or global footprint exposure? I'll ask the question again. What access is preferred? I guess this is referring to the RisCura China Equity Fund and its exposure, mainland or global footprint exposure.
Yeah, so I think this question refers to the Chinese companies tend to be, I guess, the two aspects. There are developed market companies that sell to China. Nvidia, right? Nvidia's largest customer is still China. So you've got that Chinese exposure. You have Chinese companies that happen to be listed on the mainland, on Shanghai Stock Exchange, the Hong Kong Stock Exchange, and the US. I'm not sure if the question is about American companies with China exposure versus Chinese stocks, or Chinese companies where they're listed, and what should be the spread. So to tackle, if we were to look at US companies with Chinese exposures, so one has those like Nvidia. I think we have a chart somewhere. It wasn't in the deck that I showed, where it shows the share prices of there's an MSCI index called MSCI World with China Exposure, which tracks the performance of companies where most of the earnings come from China. And if you compare the share prices versus directly Chinese companies, and there's been a like this, right? Completely like that. You can imagine, because those companies are Nvidia, Qualcomm, some of the hardware tech companies that you have in the USA, or some of the mining companies. So firstly, to invest directly in Chinese companies, whilst it comes with higher risks, that's why we have a smaller allocation to say US companies, but still you've got some of those companies with better growth prospects, and they are priced much more attractively. So that is with China exposure directly versus American companies selling to China. So that's the first part. And then the second part is that the answer is quite straightforward, is one should look at Chinese companies regardless of where they're listed. So we tend to prefer managers that specialize in finding the best investment opportunities in China, where they happen to be listed. Could be in Hong Kong or Shanghai or in the US. They are all Chinese companies. The listing is just a side factor. There's a separate corporate governance issues, but the companies are all Chinese companies. Excuse me. So there's RisCura China UCITS fund, for example. It uses the benchmark, which has the widest investment remit, companies across the world, regardless of where they are, which are Chinese companies.
Awesome. I've got another question from you from Bruce Williamson. Thank you, Bruce. So the question goes as follows. China's manufacturers are highly dependent on exports to the US. In turn, the US consumer equally dependent on Chinese goods. Potential Trump tariffs could cause significant damage to both countries and knock-on effect globally. Your thoughts?
Yeah, so true. It's going to be should Trump go ahead with that, that will create challenges for people across the world. It is going to be very inflationary in the USA, and depending on how the Chinese react. So the implications are actually really global, not just to Chinese companies. Remember, whilst the economy, a large part of the economy does come from exports, a lot of the investment remit in Chinese companies is actually about investing in companies targeting Chinese consumers. So they are irrelevant and kind of like unrelated to the exporting part. Just talking about the short to medium term aspects on really as tariffs come and how does that affect exports. A well-run Chinese company has already been adapting to it. It has been building factories in Singapore, in Southeast Asia, in Mexico, in other countries in the world. So really those products that come out. To give you an example, Haier, which is the world's largest home appliances company, fridges, freezers, that kind of stuff, some years ago bought General Electric's consumer business in the USA. So General Electric Home Appliances is actually a Chinese company. So all that Haier does is sell its parts to USA. They get packaged up as a General Electric fridge and sold as an American fridge with an American historical brand. They're not subject to tariffs. So a good company has already been adapting to it. This thing started in 2018. It was only going to get worse. Another example, BYD, becoming very quickly the world's largest manufacturer of cars. So people may have read about the EU putting sanctions, not tariffs, doubling the tariffs for electric vehicles coming out of BYD. Well, BYD is building a factory in Hungary. So BYD cars are not going to come from China. They're going to come from Hungary, which is an EU country. And there's no way to slap on tariffs on cars coming made in Hungary, which is an EU member state run by a guy called Orban, who's already a very feisty character in the EU. So really the key thing for tackling tariffs is about Chinese companies being smart about how they actually manufacture their products.
Awesome. Thank you so much. So we have a question from Kefla, who is asking you to maybe just quickly go through your first slide again. So I think this is pretty much, I think, where you were highlighting the impression that global investors have on that. And then there's also, maybe whilst you're putting your slide deck, there's another question from Sean, who is just trying to understand the currency impact of an allocation to China. So if I get the question correct, he's sort of trying to get a sense of, is there meaningful diversification away from the dollar if one invests into the China fund? And he's also trying to get a sense of the China-ZAR relationship in that context. So I'm also happy to add a few comments. Also happy to help you with any one of those questions. You can just let me know. But yeah, there's those two.
Yeah, so maybe just tackle the second question first. These tariffs could have an impact on the currency that would be so what you would expect, and the right retaliation for that would be to let the currency drop. That kind of nullifies the effect of the tariffs. So currency could drop. That that should, if you're an exporter earning dollars, that should have less relevance. That would and could reduce the expected return from companies that are selling in China and earning in their local currency. That I'm talking about the relevance to investing in shares in China as opposed to other asset classes. But very importantly, the drivers of the growth of Chinese companies selling to China are far more driven through some of this slide that I'll come back to now. So really, the future prospects of a company that's selling, say, premium alcohol to Chinese citizens is really about the recovery of the Chinese economy. And should that and as that happens, as it has been happening, their stock prices are going to significantly go up far more than a potential reduction in the currency. So even in US dollars, that would be very attractive. And I would like to say that really right now the impact on currencies actually globally, not just Chinese, will really be dependent on what Trump does with rest of the world. You think that's enough for the second question?
That is, I'll maybe also add to say, I think you do get significant exposure to the Chinese yuan currency, not necessarily the dollar in the China equity fund. And if you look at measures like the purchasing power parity theory, the two currencies that are very cheap compared to the ZAR, or one of the only two currencies where the ZAR is actually expensive, not cheap, is the Japanese yen, where the upside, I think, is well in excess of 20%. And that's on the developed market side. And on the emerging market side, one of the currencies cheaper relative to the ZAR would be the Chinese yuan. So certainly there is some diversification away from USD dollar dominance in portfolios with the China RisCura BCI China Equity Fund. Yeah, I think that's probably what I would add to over and above to everything that you've said.
Yes, and all that I've read basically talks about the short-term impact of some of the things that Trump plans to do could lead to, at least in the shorter term, dollar becoming even more expensive, which will impact all of us, including Chinese. So yeah, absolutely. Just coming back to this chart, we can split it into potentially 1, 2, 3, 4 things. One, China being a command-driven economy. That's always been the case. The geopolitics, the Chinese economy in these last few years struggling, and the longer term population dynamics and demographics. Just talking about China being a command-driven economy, absolutely correct. That's come with advantages and disadvantages, but disadvantages being obvious to most. But from an advantage perspective, I think the progress that China has seen in these last 20 years has partly been because it's a command-driven economy. When they have the right reforms and when they seek to develop the country's infrastructure, for example, it really happens, and it happens overnight. Tackling pollution is a very, very good example. So, until as recently as 2008, you couldn't breathe air in cities like Shanghai and Beijing. They were by far the most polluted in the world. Today, blue skies. And that was because the government really took action and there was a remarkable change. Similarly, to climate change, China is very much as a country committed to net zero. Although they've been very realistic, they've at least maybe realistic that we're not going to get there by 2050, but 2060. But they are, and so people in the country know this is important, and they are tackling and are very aware of that the government wants to reduce emissions. These are some just small examples. So advantage and disadvantage of a command-driven economy. Geopolitics is the new dynamic, and that is here to stay. And this is why what we call, we also advocate that one should be an active investor in Chinese stocks. A lot of companies in China have bad governance, and one should avoid those companies. And also, when it comes to geopolitics, one should be looking at any company, right? Actually, any company in the world. It equals to a US company that is dependent on Chinese products to come in, or parts that come from China, or a Chinese company exporting to the rest of the world. The geopolitics is an important aspect. So when an investor looks at a company, they should really look at how could geopolitics affect the prospects of the company. Some actually benefit from the geopolitics. So a big investment theme in China has been about self-preservation, becoming self-reliant, and investing in tech that is significantly improving in China to compete with USA, and Chinese companies buying their local tech because they don't want to be exposed to the geopolitics. So as a result, if you are selling to say Chinese auto factories, say you're selling industrial robots, and the world's largest manufacturing hub in the world, of course, is in China. So the Chinese factory is going to be giving preference to industrial robots made by Chinese companies. As a result, that company actually benefits from the geopolitics. And lastly, I showed you that slide on Huawei, which just shows you how Huawei's continue to prosper despite significant geopolitics. I mean, really, you have to go to some of their stores to actually see how phenomenal the Huawei story is. The slowing economy, I kind of talked about how it's coming to recovery. That's really dependent on stimulus coming from the government, which surely it is, and you are beginning to see the signs of a recovery. I showed that slide where, whilst early days, how the real estate sector has started to recover, although short term, since some of these recent stimuluses have been announced. As a result, the boost you could get from Chinese consumer companies could be significant should there be very, very small changes in, say, consumer consumption growth. Lastly, on the population being growth being slowing down, I'm going to say two things about that. Number one, first of all, what some of our Chinese people say is they're gonna become rich before they're gonna get older. And so one of the big things in the last I guess 10 years of investing in Chinese consumer companies is Chinese consumer companies selling better product with higher gross margins to a more affluent Chinese consumer. So actually, if you're investing in consumer growth, say over the next 10 years, an aging and prospering Chinese population is actually a good thing for investing in a Chinese consumer. Now, on the flip side, when we talked about productivity, China being the cheapest manufacturer in the world, if your workforce is reducing, then you need to go up the productivity scale. And to touch on that, there's been some remarkable changes in the last few years. And just to give you one quick example is Xiaomi's dark factory in Beijing, which we went to recently, churns out a mobile phone per second. It's called a dark factory because not a single person works in the factory line. Just stop that.
So I've just been given an extra 2 minutes by Eugene because we're sort of fast running out of our time. So I want to sneak in the two questions we have. There's one around is there any concern, I guess, concerning the RisCura China Equity Fund when we think about the threats that China is leveling against Taiwan? So that's the one. I know you sort of already covered it, so you don't have to cover that in a lot of detail. And then the second question is, do you expect China to still drive commodity pricing in South Africa, even though they're transitioning into a consumer-driven market? And maybe I'll throw in the last one. What is the correlation of the RisCura China Fund to the SA market?
Right.
So if you can
So
answer those in 2 minutes. Sorry about that.
yeah, okay. So oh, I've already forgot the questions. So let's just talk about the correlation. I'll have to come back to you, lowish. We have a chart which shows, I don't have a direct correlation thing between South Africa and China, but if you were to look at Chinese stock performance and EM ex China's performance, then the correlation is low. The exact numbers I would need to come back to. I just want to throw numbers, and it's been falling. It's been falling. The correlation benefit, the diversification benefit has been increasing in these, say, the last 5 or 6 years. So that's the question on diversification. I should really written it down quickly. The first one was Taiwan. Yes. So on Taiwan, the only thing that I would say is this has been an issue for a long time. It's always been the case, the Taiwan-China issue. And it's not a new thing. Something like a war is not a China thing, it's a Taiwan thing. And what we can tell you is all the research that we've done is there's no appetite by the Taiwanese population to change the status quo. Should the Taiwanese people, the Taiwanese government say we want to become totally independent from China, then that is a risk. But that's not the case. Like we can tell you categorically. So we think that's a far lower risk, and it should reduce under Trump. I think the Taiwan specifically, Trump. It's going to be a lot about trade and trade tariffs. There's no doubt about it. You should expect the China-Taiwan thing tall under Trump. And the second question was very quickly.
And then the last question, really in a minute, is just around with China transitioning into a consumer demand economy, will it still have an impact on commodity prices? I guess this is still
absolutely. Yeah, absolutely. 100%. Globally, that is your real, that's a big delta. The recovering of the Chinese economy will have a direct impact on commodity prices.
Okay, so that is still intact, not broken yet.
Absolutely.
Awesome. Thank you so much. Thank you so much for all the questions that you gave to Faisal. Faisal, thank you so much. It was great spending time with you this morning. I'm going to hand you back to Eugene.
Tuvonga and Fazil, thank you so much for unpacking the China opportunity for us. It was very insightful indeed. We know that global managers don't really look at China, although a lot of them don't look at China. So if you think this might be a good opportunity for your clients and something you want to get into, then look at the RisCura BCI China Equity Feeder Fund, available on most big platforms. Let us know if you want to get in touch with either RisCura or Apex Investment Consulting if you want to take discussions further on China or their views on emerging markets, or even some of their solutions and how they include emerging markets or China into various mandates and portfolios. Again, thank you to Tuvonga and Fazil. It's been really insightful. And thank you for your time this morning and preparing for these presentations. We are really grateful. Thank you so much.
Thank you very much.
Thank you.
Good stuff. As I mentioned in our introduction, unfortunately, this is the last session for 2024, sadly so. But should you want to top up on your CPD points and recap on some of the topics we discussed, we'll be sharing the recordings of the September roadshows with you So keep an eye out for that. It will come from BCI Marketing. You can watch those recordings and complete a couple of easy questions, and you'll get a couple of more CPD points and get yourself ready for the cycle. Keep your eye out for invites on 2025 boutiques on Wednesdays. We'll also be sending out invitations for the February 2025 roadshows. That should be coming through to you in the next couple of weeks. Then you know what to do for early in the new year. From Robert Walton, Tanya, Olga, and the entire BCI team, we want to thank you for the tremendous support you gave us for 2024 and the past 11 years. BCI is now officially the largest Manco in South Africa, and it's all thanks to your support, so we remain immensely grateful. We want to wish you all a very blessed festive season. Enjoy the time with your families and your friends. It's been a long year. It's been a tough year. So enjoy the time out, rest well. And if you are traveling, please travel safe. We're looking forward to seeing you all back here again early 2025. And be blessed, go well, and I'll chat to you soon. Thank you so much.